Hey, good morning, everyone. Marty Missouri here, Friday, the 7th of July, 2023, with your weekly economic update. Going to keep this one really short relative to what I normally do on this presentation, largely because I went so long on yesterday evening's stock market, let's just call it market snapshot, that I sent to you this morning, clients. That one, if you haven't looked at it yet, and it's still pretty early, so most of you probably haven't, but definitely I'd like you to take that one in. It goes long, but I go pretty deep into the weeds, and I think important weeds. I don't spend so much time on the charts. I get that out of the way first. It's that monologue, the last 2/3 of that presentation, and I cover quite a bit of ground there that I'd like clients at least to take in. As for the economy, of course, we got jobs numbers this morning, so we'll briefly touch on those. I've only dialed up a half a dozen of our charts, and I'm going to borrow another one to emphasize the point I made on yesterday's video with regard to excess consumer savings. So in front of you is our PWA index. We actually went down a couple points to a -19, still firmly in the territory that says recession odds are higher than ongoing expansion odds for the foreseeable future. As for the inputs that I'd like to run through this morning, U.S. auto sales ticked up just a little bit month over month, not much to report. Trend isn't bad, but certainly not robust and let's say choppy, if not noisy. The labor market report this morning, 209,000 was off of, I think it was 230,000 was anticipated. Market rallied a little bit on that news, and it's kind of just marginally higher right now. Again, like I said in yesterday's video that I sent out to you this morning, if we had a weak number but not too weak a number, it would be really good for stocks. If it's a strong number like yesterday's ADP number, it would be really bad for stocks. So it was weaker, but hourly earnings year over year were up 4.4%, 0.4% month on month. Average work week actually picked up a little tiny bit as well. Unemployment rate went down a tick to 3.6. So underlying data, the kinds of things like wages that the Fed is looking at to gauge inflation prospects and to the degree they should continue hiking, there was nothing in this report whatsoever that would stay the Fed's hand for a July rate hike. That's very much priced in. I don't think they'll want to disappoint the market relative to expectations, so we'll get that July rate hike. It's going to be the data between now and September. They skip August. There's no August meeting, so between now and September will be key in terms of market action relative to the Fed and prospects for another rate hike. Certainly not a cut. Also this week, job openings came out. It moved back below 10 million. Still a lot of job openings out there. The quits rate, interestingly, actually ticked up to 2.6. Now again, the quits rate says good things about the economy. When it goes up, people don't just walk out on their jobs unless they have better prospects in their minds going forward. The Institute for Supply Management PMIs, Purchasing Managers Indices, came out this week, and manufacturing looks abysmal. We are deep in recessionary sentiment with regard to manufacturing, and then we get yesterday services, which pounded higher to a very positive 53.9. Anything above 50 says expansion, below 50 says contraction. So quite the divergence here. Again, this is more consistent with what you see when you're out and about. Now, when you look back at these, and we've done this before, see how manufacturing tends to lead services, right? So if this plays out like it typically does, we will see a recession when the services sector rolls over, and I'll talk in a minute about what has been driving the services sector, we think, and how the outlook for that is going forward. Global PMI, this is a look at the world's Purchasing Managers Indices, and that's rolled over pretty good from above 54 to 52.7. Again, still expansionary, but that's a notable decrease in overall optimism. Still growing, but not at the pace they were the month before. The Baltic Dry Index still trending lower. I mean, it's a noisy one, and this speaks to the state of the global economy. And as you can see, again, it's noisy, but you can see, its trajectory leading into, economic slowdowns, or here's, the last 3 recessions, and so we've got quite the downtrend in here. And then lastly, in this morning's macro show, Hedgeye Risk Management, who we subscribe to, this morning coincidentally touched on something I touched on yesterday, and that was the fact that the resilience of the economy and therefore the markets, I think, to a large degree this year, to no small degree, owes to the large surplus in consumers' bank accounts. It was $2.2 trillion at the peak post-COVID with all that money that was given to people. It was, I still think, north of $1 trillion at the beginning of this year, down to about $500 billion at the latest report, and at the current burn rate, it would be all gone by September, and that's not inconsequential, we think. And again, yesterday, I talked about that versus Fed positioning and kind of the tough spot the Fed's in, and therefore the markets are in as well. And I mentioned that the bottom 2 rungs of the income ladder actually had less in their bank accounts than they did pre-COVID. Well, according to Hedgeye this morning, yes, that's true. Here's the bottom quintile. Here's the second from the bottom quintile. So looking at, say there's 5 rungs on the ladder, this confirms what I said yesterday, that folks have less in the bank today than they did pre-COVID, right? So here's that bottom quartile, 47 billion versus 50 billion pre-COVID. And then the next up, the 20 to 40% quintile, not quartile, 62 billion versus 69 billion pre-COVID. And then that third from the bottom quintile, 207 billion versus 211 billion. So this is not good. And again, that's how I put it yesterday. That money has moved up into the pockets of folks who don't spend nearly the percentage of their income that these folks do. So that is a red flag with regard to what we're seeing in overall consumption going forward and what we're seeing in things like the services PMI. So while on the surface, and you're hearing a lot of this, there's no recession, but when we look at these more forward indicators, we think that you can be dangerously sanguine right here, and that things can come to a halt relatively quickly, or we could see things roll over that have been holding up relatively quickly. So we want to be careful with how we allocate assets with that potential out there. Stay on our toes and be open to all possibilities at all times. Folks, I'll leave it there. Hope you have a wonderful weekend. Really appreciate you watching and listening. Talk to you soon. Bye-bye.